All right, so we are back with the show. What a crazy scenario over here. I apologize, everyone. Had to kind of switch over. A lot of logistics in the back end. So let me go ahead and wait for some people to join. I know, right? Like that. It was seriously the craziest scenario right now. I wish I could explain it to you, but we don't have time to do that right now. But let's go ahead and see what is happening after hours over here while some people join. Yeah, dude, that was a wild scenario. We are back. We are back. Hopefully, I'm not going to blink as much this time around. All right, so the Qs are basically flat after hours. I did put a poll on the other stream. I didn't see what the results were, but I was asking you guys where you think the market's going to close tomorrow. Do we think we're going to be green tomorrow? Do you think we're going to be red tomorrow? We will see. I mean, historically speaking, guys, we have seen the market top out on Wednesday for the week. So you'd see the weekend and the markets would open the futures like very low and it'd recover it Sunday night and it would gap up on Monday morning and it would close green Monday morning. And then Tuesday's like a little bit of a chop. And then Wednesday it closed higher off of optimism. And then Thursday would be the sell-off. And Friday is like a big question mark because we don't know what's going to happen. But I'm wondering, what do you guys think is going to happen tomorrow? Because personally, we've seen a lot of selling lately. Do we think we're going to get a bounce? Do we think we're not going to get a bounce? Maybe I should put that poll up again here. Let me actually do that for you guys. I think I could actually do a poll over here on Restream. No, I don't know if I can. I thought I could over there. So I'm going to do it over on the YouTube. I appreciate you guys for tuning into this one. I apologize again for switching it up on you guys, but it is the show that still must go on over here. So I'm going to go ahead and do this one real quick. All right, let me throw this poll. All right, so how do we end the week? Friday red, Friday green. All right, I'm going to start the poll right there for all you people that are joining in late. Again, I apologize for switching out. I do want to play the rest of that clip because I did find that one pretty interesting over here. So I'm going to play the rest of that clip and then we can continue with the show here. We also have a few things that did happen after us that I do want to share as well. So let me just throw this one. Oh, that's not the one. Okay, hold up. I forgot I switched browsers, so I have to open it up on Microsoft Edge. Here we go.
Guest recently warned about contagion.
I think to our way of thinking, it's that contagion which is creating that opportunity where our investments are going.
It's not a baseline for you, though, that we wind up in a recession, is it?
It's not. Yeah, you know, the positive impact of technology, just how it is driving economic growth. We think there are two things conflicting with each other: a real economy which is really troubled, with a technology business which is really driving growth, capex investing. Right? Our base case is there's no recession. But our base case is, at the same time, credit spreads widening out substantially from here. And that has happened in the past. You know, a decent economy, okay equity markets, and credit spreads, which really kind of...
We actually have some news that did come up over here. It looks like Trump is... Hold on a second. I saw it over here. He's actually pausing the destruction or something like that till the end of it. All right, so I'm going to bring this up over here real quick. All right, so we have U.S. President Trump, as per Iranian government request, please let this statement serve to represent that I am pausing the period of energy plant destruction by 10 days to Monday, April 6th. Talks are ongoing, and despite erroneous statements to the contrary, by fake news, they are going well. So right now we do have the markets bouncing a bit after hours. Let's take a look at what they're doing. Oh, wow. They just kind of gave back some of those after hours gains. We have the Qs up about 40 basis points over here. It was bouncing a little bit more than that. Let me go to the 10-minute chart Yeah, we did have a lot higher of a bounce. Qs went all the way up to 580. Now they're giving back half of those gains, and they're only up about 45 basis points, which is a considerable bounce because that's exactly where we were less than an hour ago, right? So that's a pretty big bounce. We still have a lot of work to do. Honestly, what do I think about this news? It looks like he's just trying to buy time. I don't. We're under the 200-day moving average. It is good to see that there's some sort of agreement here with the Iranian government to extend the plant destruction. The question is this going to lead to a resolution? Now, actually, let's look at oil prices after hours. I don't have the real-time oil prices here, but we do see that USO did drop all the way down to 111, but since then it's giving back some of the losses, or it's pairing some of the losses that it did just have. The Qs are up about 56 basis. Maybe we're coming back a little bit here. Maybe this is something good for the market right now. I really have a lot of trouble kind of deciphering exactly what's happened here, because every time we have this optimism in the market, we just end up pulling back lower. For me, though, I'm about 10% cash. I mean, I'm still very much long the market. So if we go back up, great. If we don't, well, I'm going to feel the pain on that. I don't know, guys, post what you bought today, because I didn't necessarily do any buying today. I've been slowly deploying money lately, trying to take stabs at the market, trying to do a little bit of trades, but of course, getting stopped out in some of those. We did have someone here say Venture Global Edison report. Calcasi past settlement. Let's see how Venture Global is doing after hours. They're down about 1%. I don't really think this is much for Venture Global. Let's see if there's some other news that's happening after hours over here. But in the meantime, I do want to see how the market's going to react to this one. Yeah, that's really all the news that I'm seeing after hours. I did see someone say something about some earnings after hours. Let's see here. I think it was Unity. Was it Unity? No, I'll have to take a look at that one. Actually, here it is. So apparently Unity did report preliminary guidance over here. So Unity exceeds Q1 revenue guidance, 550 million to 580 million with preliminary announcement, shuts down Iron Source ad network. So what does that mean? Is Unity exiting the ad business for gaming? Maybe that's what it means. I think the turnaround story for Unity is that they need to focus on ads. Let's take a look at how Unity is doing after hours to see if maybe we're getting a little bit of a recovery there in Unity. Wow, Unity is up 20% after hours. That's wild. But it did give up a lot of its gains lately. Yeah, Unity was all the way up at $52 and it gave up most of its gains. It's up 20% after hours, which is good to see. App11 is up about 2% after hours, but I think that's with the market bouncing right now. That's the reason why App11 is up. Reddit is in the 120s. Shout out to anyone that bought the Reddit today. That thing continues to be sold off pretty handsomely lately. I would personally say that I'm going to wait till we see some recovery to buy into Reddit if we do get some recovery in the near term. It does trade pretty cheaply, but a lot of expectations are really built into this one. I did try to do a trade on Reddit recently, but I ended up getting stopped out. Let's see how the Qs end up. I mean, I think we're going to just have to see some fall through into tomorrow because it looked like it's giving back a lot of those gains real quick. Nice work. You did a 10% trade on Unity after hours. Definitely lock in some gains if you're trying to take stabs at the market right now, because you really don't know if some of those trades are going to end up well. There was this news after hours, which I did share earlier, that we did have Meta basically, how do you say when they do 6 times on data center over there? But $10 billion. Obviously, the data center story is continuing over here. Let's see how the data center stocks are doing after hours. They're probably up a little bit with the market bouncing. It's up only about 35 basis points after hours. Data center stocks, yeah, Nebius is up at 1%. That's like basically a tick on Nebius today. So, but it is nice to see Nebius up a little bit after hours. I'm gonna wait and see what's gonna happen to start deploying some cash. I want to see some recovery in the stock market. Yeah, those were Unity preliminary earnings. But we did talk about the credit crunch that is unraveling right now. I don't know if there's going to be a massive credit event happening, but one thing we do know about credit events is that they don't occur because there actually is a credit crisis. Credit events occur because people are anticipating a credit event. So essentially speaking, you have these private credit companies that retract their money, or they put caps on redemptions, which makes people a little more scared that they can't get their money back in the private equity markets, which causes further fear into it. We do need to see that stop happening, but from what I am gathering, especially seeing that you do have a lot of these large valuation companies going public, specifically with SpaceX. SpaceX did announce that they are doing a little bit of downsizing here with their company, and that 30%, I believe, of the IPO is going to retail. I think that's what I saw with SpaceX earlier today. Let's see here. Trying to look for that news on SpaceX. I believe they're giving the majority of their IPO to retailers. Oh, here we go. This was the one that I saw at SpaceX earlier. So SpaceX IPO may allocate 30% to retail investors as Musk restructures X with job cuts, a seismic shift signaling a gamble on everyday investors while headlines scream layoffs and pivot. Well, this book. So I mean that's kind of the thing here. I mean, are you guys planning on buying the SpaceX IPO? I don't think I'm going to be buying the SpaceX IPO. I think I'm definitely going to stay away from that one. If anything, it might end up going up as soon as it IPOs, but it's probably going to be oversubscribed, which means that whatever it's planning an IPO at, it's probably going to open up a little bit higher than that. I personally don't trade IPOs. It's very risky to do that. And if I were to trade an IPO, it would be like with a very small amount of money, just in case it goes down a lot. I would, in this current market, this really reminds me of like in 2022 when you had tons of IPOs happening and all that excitement that had happened from these IPOs back in 2021. All these IPOs got sold off into 2022. So I'll kind of be careful about this, especially with the space stocks. You did see a bit of a run up with the space stocks lately, but today you saw a lot of those gains being given back. I mean, Rocket Lab is up very considerably in the last couple of years. And being that it's at $66, I would say that a lot of it is kind of priced in for Rocket Lab. Obviously, we're planning on holding Rocket Lab for about 4, 5, 6, 10 years. It probably really doesn't matter where you buy it today. Like I know there's like a lot of people where it's like, oh, I'm going to own Rocket Lab for like 20 years, but I'm going to get like a 10% discount. Like that, some of that stuff doesn't really make sense to me, because if you are going to own it for 20 years, getting a 10% discount off today's prices really isn't going to matter. But if it's anything, you probably do want to DCA into it as well and try not to call the bottoms on it in size, because you might end up getting shaken out. ASTS was down pretty considerably today. It was down about 10%. Obviously, there's probably not going to be any news in these companies today. It is definitely a sell-off driven event. Let's see what Meta's trading at after hours. Meta is up about 50 basis points after hours. So I do see that this pump that we did get after hours is kind of fading a little bit. Let's see how this turns out maybe in like 30 minutes. Sometimes like these pump after hours, they do have some follow through. Like, what was it, last week when we got that pump after hours? I believe it was Friday, right? So last Friday, the market was down. I think this was like a 2% drop last Friday, 1.5% drop last Friday in the Qs. And then you got that pump after hours that Trump said that they were nearing a deal or something like that. And the market did gap up on Monday and went all the way up to 594 on the Qs and then pulled back into the close. And we've just been kind of drifting lower as the days went on. So we'll see how this pump ends up after hours. It looks like it's kind of fading over here. So I'm just going to watch at this point. Why hold Rocket Lab when every day it's up and down 10%? Just trade it. I look, if you know exactly when Rocket Lab is going to go up 10%, when it's going to go down 10% before it happens, well, let me know. And that way I could trade it too. But I don't think anyone's that good that they can possibly trade every single move in Rocket Lab. And some people, they just do want to invest in the long term. They don't want to trade positions. And that's totally understandable, because if you've bought and held Rocket Lab those $4 and didn't trade it, you'd be sitting on a 15 times. So that just might not be the game that everyone wants to do. So we will see what happens with that one. I would have bought SpaceX 5 years ago. Yeah, actually, I think 5 years ago it was like a $250 billion valuation. Today, obviously, they're a $1.5 trillion value. Actually, I think it was less than that 5 years ago. I think it was like more like $150 billion valuation. So things are getting a little bit exciting lately, even with the S&P down about 2% today. It isn't down a massive amount from its all-time highs. In fact, let's take a look and see how much SP 500 is down from its all-time highs. If its intraday high is over here, then that would put the top at about 7,000. And today it's down about 7.5%. But if we look at the NASDAQ, I think this was the all-time high was here about 26,179. And that would put it at almost correction territory in the NASDAQ. So that's down 9.9%. I think it was a little bit lower today, right? The low of day was 23,574. So yeah, it was like just in correction territory. But that's it. When I'm usually measuring all-time highs, I'm usually basing it off of the all-time closing high, which would put it right here to today's close, which is 86. So that's like 9.7% down from into correction territory. So not exactly in a correction yet. But I mean, let's just wait and see. Let's see what happens over here. Do you see any safe havens during the last couple of months? Honestly, the market has been telling you what the safe haven was for quite some time. And if you look at XLE, this thing is continuing to make all-time highs every single day. You could have bought XLE at the end of February and you would have been up about 10, 20%, right? So the market was kind of tough. Like, just look at the year-to-dates for a lot of these. If I go to the year-to-date, I'm going to switch this over to percentages and switch this over to a line chart. XLE is up about 34% year-to-date. Materials up about 6% year-to-date. Industrial is up 2% year-to-date. Real estate just turned red year-to-date, but it's basically flat. Utilities is up 5% year-to-date. Healthcare is down 8% year-to-date. No, that was tech. Tech is down 8% year-to-date. Healthcare is down 7% year-to-date. XLY is down 8% year-to-date. Communications, Google, and Meta is down 7% year-to-date. Financials is the worst performing one out of all of them. It's down about 10% year-to-date. Look, if financials are not recovering, then it's going to be very difficult to time exactly when the bottom is. Usually when financials are pulling back pretty considerably, it's not going to bode so well for us, the stock market. In fact, I would even say that if we don't see financials come back pretty dramatically, it's not going to pose pretty well for the expectation of a recession. Now, I'm not saying we're going to have a recession. I'm just saying that the odds of a recession certainly do go up when financials pull back pretty considerably. Let's take a look at the poly markets over here and see what the chances of a recession are by the end of 2026. We have a 36% chance that a recession is coming by the end of 2026. Just earlier in March, it was about a 20% chance. So this recession indicator is actually happening. Canada is actually projected to be at a 44% chance of being a recession by the end of 2027. Why in the world are they saying Canada's going to be in a recession a lot sooner? But if I do go to the ECB, the European Central Bank, they are projecting a 78% chance that we will get a rate hike by the end of the year. That is very high odds we're going to be getting a rate hike by the end of the year. If I look at the Fed, how many will the Fed rate hikes in 2026? This is a lot lower. It's about 25%. But just earlier this month, this is at 6%. So the market is starting to price in a rate hike by the end of the year. If I look at the Fed funds future and I look at how many rate cuts by the end of the year over here, you're having about a 30-40% chance that we don't get a single cut by the end of the year and a 56% chance we get one cut by the end of the year. If I do look at end of 2027, you have about a 34% chance we're going to get about 2 rate cuts, I believe. Yeah, that's 2 rate cuts by the end of 2027. So the Fed had its summary of economic projections last December. I'm pretty sure they had the summary of economic projections that they did release in the last Fed meeting. So they basically think that, actually, no, I'm going to look at the PDF of this. Where's the PDF? That's the one for, I want to look at the PDF for March. Here we go. So the PDF, this is the big table that we see. Federal funds rate was, for 2026, was at 3.4%. In December, they did say the same. 2027 is when we saw the big change. So in December, they expected rates to be as low as 3%. And then they changed the projection to 3.5 to 3.6%. That's where the adjustments came in, and the market got a little bit scared because of that one. If you look at the unemployment rate, they do expect unemployment to be pretty much the same, in line where it was in December. But they did increase their inflation forecast up about 2.7% versus 2.5% since last December. GDP, they did increase their GDP forecast for the end of the year, but they do expect GDP to be at 2%. So I think this is where the market is going, right? So they had this, they had the Fed meeting earlier this month. This was March 18th. This is like a week ago. And since then, the projection for the amount of rate cuts actually has dropped for the end of the year. Now they're starting to price in rate hikes by 2027. So definitely keep an eye on this if you really want to look at the impact toward the markets, because as you can see here, as the market continues to price in a higher chance of a rate cut, that's the reason why you're seeing the stock market kind of drift a little bit lower. And it does usually have its like ebbs and flows, right? So remember last April, you saw the forecast for a recession coming up pretty high when the market was at its lows, and then the pendulum swung to the other way, and you saw the recession forecast kind of drift a little bit lower, the market recover. We're probably going to see the same thing happen at some point this year. We just don't know when, right? If we do know when it's going to happen, then obviously we can make our bets and think the market's going to go up. But until then, it's very difficult to see when that's actually going to happen. Let's see how the Qs are after hours. Yeah, the Qs are, let me switch back to the screen. The Qs are, let me go over here, and I'm going to go back. Yeah, so the Qs are, switching back to these tables. This one for the Qs. The Qs are, they're drifting. They're still up about 38 basis points after ours. Trump extends deadline for negotiations with Iran and pauses threat NVDA. Yeah, we already saw that one when that news came out. I do want to put on something here. I don't like how it's not the correct theme that I wanted. Anyways, guys, let's see what CNBC is saying after hours. Oh, they're still in a commercial break, according to this. All right, here we go. Yeah, they're still in a commercial break. I'll see what's happening on the news wire in the meantime. But overall, not such a great day in the stock market. What do you guys think? Do you think that we're going to bounce in tomorrow? Let's see what those polls actually do say. I'm going to close this poll right now. We have, where did that go? I don't see where that poll went. All right, here we go. We have about 61% thinks the market's going to be down tomorrow, and 39% think it's going to be green. And that I left that poll open even after we saw that pump. So we're going to, so someone just said, I think we're cooked. It looks like we might be cooked at 61%, think it's going to be down. But I guess if we're like thinking contra a little bit over here, maybe there's a 40% chance we're going to be down instead of, there's a 40% chance that we're going to be down instead of the 60. So I try to be a little bit optimistic here, but I'm not going to try to call bottoms over here. Let's actually take a look at the fiscal AI and see what some of these valuations are with Meta, because we have been seeing Meta drop pretty considerably. I'm going to share this one here. I actually have, this is the valuation tab. No. All right. I got Mag 7 over here. All right, so we have forward PEs for Apple's at 30 times. We have Alphabet at 25 times. We have Meta at 19 times forward PE. We have NVIDIA at 24. We have Microsoft at 21. We have Amazon at 27. Actually, this is actually a very low for Amazon. Amazon usually trades around like 35, 30-ish, and now it's at about 28. Year-to-date performance, Apple's down about 6%. Alphabet is down 10%. Microsoft is already in correction territory. Meta is down about 16%. So out of all these, Microsoft is the worst performing one. That probably has a lot to do with the software scare that we're having over here. So valuations have become quite compressed a little bit. I would think out of all of this, the largest beneficiary of the amount of spending we're seeing is going to be NVIDIA. The question is, can NVIDIA get a little bit cheaper here? Every single time they release their earnings, I'm always like so surprised why they keep selling off. It really does seem like the market doesn't believe NVIDIA is going to be able to sustain these growth rates. But if you look at these data center growth rates, we see here that they've been accelerating their data center growth for the last couple of quarters. But every single time we have a quarter of NVIDIA, it always sells off. Their data center revenue, this doesn't look like it's ending anytime soon. In fact, last quarter, like I said, they accelerated the data center revenue, and it just keeps going parabolic. If I go all the way back here to January 20, like look at these numbers down here. Their data center revenue was less than $1 billion on January 20 for that quarter, and today it's about 62 times that amount. It's crazy, right? Growing at 75%. And they forecasted additional revenue growth next quarter, but the stock continues to be sold off. Are you guys buying NVIDIA right now? Do I own any of the Mag 7? I own Amazon. I own Meta as well. I don't own NVIDIA, but I do own other semiconductor stocks here. In fact, I have pretty much all of the stocks that are in my portfolio over here. Rubrik had a pretty decent day today, but Amcor is down about 10%. So obviously the portfolio is hurt a little bit. I do own some Meta here that's down about 8%. Nebius down 8%. OSS is down 6%. I don't own Circle anymore. I sold that one this morning for the swing. I still own Marvell. Marvell is probably one of the better semiconductor stocks that I do own right now. They had a really good earnings last quarter, and arguably it's been sustaining a lot of that momentum since they reported their quarter. Before they reported earnings, Marvell was like in the 70s. So it's actually up higher since they reported their earnings still. Grab continues to be bleeding in the portfolio, and there really is nothing. This is like one of those stocks where, yes, it's very cheap right now, but it continues to get cheaper. And Grab did just announce that they are acquiring Food Panda, which is in Taiwan. So they're expanding to Taiwan, and they have a considerable amount of cash in their balance sheet. Like I can tell you right now, Grab is a very cheap stock, but I'm being mindful here. Cheap can always get cheaper. And have I been adding to Grab lately? I have not been adding to Grab lately. I've just been holding on to my position. My average is around $3.85. So after 2 years, I am red on the position. And that continues to go down further. I'm still going to hold on to it. It is not a big position for me, but it does suck to see that it went from $6.50 all the way down to $3.70. Zeta, still holding on to this one. Not planning on adding to it. I already built the position out, so going to let that one ride. I was looking at a few stocks lately. Next Decade is up about 11% today. That's pretty crazy. Man, I remember when this thing was like $5 just like the other month. When was it? Just a month ago, this was a $5 stock, and it's up almost 60% on the day already. Crazy. VG was like less than $10 a month ago, and then now it's already at $16. Wild, man. Wild how these stocks are moving lately. You know, the one company that probably makes a bit more sense to me why it's selling off is Mercado Libre, which is the Amazon of Latin America. And I've always attributed Mercado Pago, which is their payment arm, fintech arm, to be like their AWS version of Latin America. but this stock continues to be sold off. And the reason why this one kind of makes sense to me is because if you looked at the EEM, which is Emerging Markets Index, this one's been selling off pretty dramatically lately. Also look at Nubank. Where's Nubank at? Nubank is it's almost in the $13 range. In fact, it did creep into the $13 range in the last couple of weeks and also today. So that one continues to pair some gains. ACLS actually is up pretty considerably lately. And this is actually a very interesting story over here. They did report earnings a couple of weeks ago, so I did get wrecked on that one. But they are getting back some of the gains the last couple of days. And it's mostly because of the news that we did see in China. So keeping an eye on this one. I don't own ACLS anymore, unfortunately. This is one of those stocks where I got shaken out of it. Be that may, if you still own ACLS, congratulations. One of the software stocks that I did buy is Fastly. This one is more in the edge computing and AI inference, and this one's been performing pretty well lately. Wish this one was a big position. It was not a big position when I got into it, but be that may, I didn't really size any positions too big lately, most because a lot of things were selling off. What do I think about Netflix? Will it hit $100 or go back to 85? If I'm looking at relative performance here, Netflix has been performing pretty well lately. Usually I'd like to look at the relative performance when I'm determining whether I want to buy something or not. And I usually don't like looking at, let me go to the year to date here. I usually don't like buying stocks that are down a lot year to date compared to other stocks which are green year to date. So if I look at let's say, for example, Netflix and Disney here, Disney has been basically falling off a cliff lately. It's down 15% year to date. Netflix is up 2% year to date. And kudos to everyone who bought Netflix when I was down here before they had that announcement that they are not going to be acquiring Warner Brothers, because since then it gapped up. It has not given back any of those gains, or very little of those gains it gained back. Still up 3% year to date. Bloom Energy. Let's take a look at that one. Switch back to the regular chart over here. Bloom Energy is at $134. This is a very expensive stock. There's a lot of future expectations built into Bloom Energy right now. I don't think I would be buying this one. There's obviously a lot of better plays when it comes to energy for AI. I honestly don't know the whole story of Bloom Energy, but this company, I believe, is trading at a very excessive multiple at this point. So there is definitely a lot of expectation built into this company. Let me actually share the fiscal AI real quick and see what is trading at. If I look at the ratios, bring up the forward valuation, forward price to sales for Bloom Energy, it's trading at 13 times price to sales. I guess that's not that bad. There's probably a lot worse before. If I look at the income statement, they're growing at about 35% last quarter. You're paying a good amount for 35% growth. That's actually a lot to pay for 35% growth. They're not even a profitable company. Let's see here, diluted EPS. They're not even earning any money right now. Hold on a second. Operating profit. They have $87 million in operating profit. Their operating margins are at 11%. Am I missing something here? I don't know. Either way, I'm probably not going to buy this stock. If anything, this is probably a good buy before it came a growth story. Or maybe it would have been a good buy back here in December when it pulled back a little bit. But if I look at the charts over here, it did bounce off the 100-day moving average. So if I were to trade this one, probably would be a decent stab over here. But I'm not trying to take stabs at something like this during a pullback, because this can seriously get decimated if we do continue to see more weakness in the stock market. Yep. So Qs are still about 30 basis points over here. What do I think about Pagaya? Let's take a look at Pagaya over here. Pretty decent bounce today, of about 3% on the day. But this had a very nasty earnings lately. I'm not necessarily looking at this one, but I do remember that earnings, it was down about 25%, and it did drop off a little bit more. Am I interested in Pagaya? Probably not. This, for me, this isn't the environment this isn't the environment where I would want to be buying companies that are not profitable, companies that had massive runs. Like, look at this, for example. If you're getting excited about Pagaya when he's here in December, you would have lost 50% of your money. And it's obviously a lot more attractive here. But I would say the going thing about Pagaya from a technical scale is that it did recover its 20-day moving average. It's green on a very red day in the stock market. It's above the 9 and 21 EMA. So maybe it looks like it's basing out over here, if you want to take a stab at that one. On the weekly chart, yeah, it kind of looks like it's basing down over here. But I don't know the story about Pagaya. I know Nate is in this one, and there's a few people on X that are in this one. But me personally, I'm going to stay away from this one, mostly because Fintech has not been doing that well lately. And SoFi continues to be a falling knife here, even after it recovered from its short report from Muddy Waters. I think that short report, some of the points that they were making kind of did make sense, but I don't think this is a SoFi problem. I think this is more, I apologize, Pagaya is gap profitable. I did not know that. But again, I haven't been looking at this stock, so your guess is as good as mine when it comes to this. You probably know more about it than I do. But going back to SoFi, so the sell-off on SoFi, you're getting a sell-off in growth stocks. So there's one for SoFi. You're also getting a sell-off on banks. So that's not good for SoFi either. This is probably more of a macro problem than anything. I wouldn't say it's going down because of that Muddy Waters report, because if you look at a lot of other fintech stocks, they're going down pretty dramatically. In fact, Shift4 gave up half of the gains that it had after we got that news from Nassau. If you look at other fintech stocks like Toast, this one is selling off. What are some other ones? Shopify. Well, this is more like e-commerce, so probably not. But this is more macro related. And the reason why I think this is more macro related is because if you look at the credit spreads over here, I do take a look at the credit spreads all the time, and they are widening. All right, actually, let me remove this. So your credit spreads is basically the differential that you see. It's basically the insurance that private markets are bidding up. It's insurance against the amount of debt there is in the private markets. I'm not a credit expert, but I do know that when these credit spreads rises, the market tends to go down. If I overlay the S&P 500 on this chart, that's actually a very bad choice of colors for making a point here. So let me make this one red. So you have red as the S&P 500 and you have blue as your credit spreads, and they are very much inversely correlated. But one thing to note here is that the S&P 500 is okay with credit spreads going up, but when they grow up dramatically, that's when the market gets very worried. So you see credit spreads come up here in September, the market dropped a little bit, and then it pulled back and the market kind of crept up a little bit. And then you saw them shot up over here in November and the market pulled back a little bit. And as they're sloping down, the market was like, okay with it. And you saw over here, the credit spreads shot up and the market kind of pulled back a little bit, and they continue to go up as the market continued to go up. In the last couple of weeks, the market's still going down while the credit spreads come down a little bit, but I do want to see the credit spreads tighten a little bit, because tighter credit spreads would mean that there's less people insuring their debt that they're purchasing on open markets, which means that things are becoming a little more risk on. But you're going to see the same thing happen with the dollar. As the US dollar rises, you do see the stock market contract a little bit. I've been looking at yields lately as well. The fact that you're seeing the 10-year come up here is definitely not good for the stock market, especially the pace that it's going up here. And like I mentioned this more than a few times as well, the MOVE index is basically your VIX of bonds, right? So the higher the volatility of bonds are, the more the market gets scared. And when you see it rise this quickly, that usually is when you start to see the market sell off and being a little bit weak lately. And it most specifically has to do with high growth stocks, because high growth stocks do tend to take out more debt with that. Yeah, Steve Eisman, that was the podcast that I listened to last weekend. And it kind of made a lot of sense to me that there is a bit of a credit crunch out there. But what he was also saying was that people don't think there's going to be a credit event. So maybe it might not turn out that way. But the fear in the credit markets is really what's kind of bringing a lot of this tech stocks down. More importantly, you have a lot of private equity companies that has massive investments on software stocks. And this is the reason why you're seeing software stocks pull back dramatically, because these software companies take out a lot of debt to fund their growth. A lot of these software companies are actually not profitable companies. They are free cash flow positive, but they are not bottom line positive. So they're not able to fund all of their growth and be able to make money off it at the same time, which is the reason why they issue a lot of debt. The problem with the credit markets when they come into this is that private equity issues a lot of, these software companies issue a lot of debt, and private equity companies do buy this debt from them, or these credit companies do buy a lot of debt for them. But as you see the compression, the multiple compression from these software companies, as you see these stocks continue to go down, you get a little people, some people who own these bonds from these software companies get a little bit worried. So therefore, they want to insure their bets a little bit. And the more they insure their bets, the more that you see of those CDS spreads or credit default swaps on the private markets expand a little bit, which is what you kind of saw with CoreWeave a few months ago, right? And Oracle a few months ago. There's a lot of talk. We actually don't have, I don't have access to Bloomberg, but there's been a lot of talk that those Oracle CDS swaps or credit swaps for Oracle were expanding dramatically. And that literally means that people who own the debt from Oracle are a bit worried that they might not get their money back. So therefore, they're going to pay more to insure their debt just in case Oracle goes belly up. Now, Oracle likely is not going to go to zero, but if you have people in the private markets worry that Oracle might go to zero, people in the public markets might think that Oracle's going to go to zero. And therefore, they're either going to hedge their bets by buying puts or by shorting the stock or selling the stock. And when you have that cascading event happen over and over again, you start to see Oracle drop down, right? And this is one of the reasons why you see Oracle basically 50% down from its all-time. I think it's like 70% down from its all-time high. And this is the reason why you see CoreWeave down significantly from its all-time high. CoreWeave is a little bit different because they're building the data centers for Oracle and they're renting out the GPUs. But really, what was once a bit of a scare for OpenAI is starting to be a contagion and spread out across the entire markets. And that's why you've seen IGV drop dramatically. That's why you've seen Microsoft drop dramatically. It's like a self-fulfilling prophecy, right? The more people that believe a credit event's going to happen, the higher the likelihood that it's going to happen. This is what happened in 2008 and 2007. People thought the credit event was going to happen at the beginning. And there are, of course, a lot of people who said it wasn't going to happen. But the more people that believed it, the more that they pulled their money out. And when you have an exit door this big and everyone's trying to head for it, that's when fear starts kicking in. Me personally, again, I don't think this is going to happen. But what I am concerned about is when a lot of people think it's going to happen. And we just don't know. We don't know if we're going to have that credit event that a lot of people are worried about. Thoughts on one-stop shop. This is actually a small position for me. I know they're actually part of the on-device inference field, which is the reason why you've seen Cloudflare up a lot. You've seen DigitalOcean up a lot. You've seen Fastly up a lot because these are more in the edge computing, but not on the on-device sector. One-stop shop is more on the on-device. And the going theme for them is that they are more on the on-device for defensive companies, which means that let's say you have defensive equipment out there in the middle of the field where there's no cell phone reception or anything, but they do want to run some queries or whatever it is on their own devices and not have to worry about that. This is where one-stop shop comes in. Now, it is a very small position for me. And because of the fact that it's a very small position, I don't agree to knowing the odds and ends about a company like I do know Amazon back to back, which is the reason why Amazon's a much larger position for me. But I would say do your own due diligence if you are buying something like this. If I look on the charts over here, we could see that it just continues to sell off and give off its pops. And this is a small cap, guys. This is a $211 million market cap. You could have any hedge fund out there short this stock in size, and it will bring the stock down. But hedge funds can't really bring a stock like Amazon down unless there's like a large fleet of them doing it at the same time. you're going to see more of an impact and volatility with small caps out there. So some of the stock talk picks that are out there, Amcor is actually a much more expensive stock, a much bigger company. So $11 billion stock, but Tower Semiconductor, how big is this one? No, that's a bad example. Some of these stocks that Serenity has been calling out. Now, Serenity has made some really good call outs, but I would be careful here because this is like a $4 billion company, and a lot of people have chased this. This is like this went from like a $1.5 billion company, and everyone tried to dive into it very quickly. And then now it's already done like a 4 times since then. So keep in mind, guys, a $4.2 billion company that everyone dives into. If you see something like this pull back, people are going to get scared and they're going to take their profits. And this is the reason why. Fundrise or VCX has pulled back very dramatically, right? Everyone got excited. They started to chase it. And then up here, people think it's going to go higher. And you have people taking their profits. And the more that it falls, the more people take profits. And you're going to get kind of like this bounce up and down, up and down, up and down until it eventually comes down to reality. This is the same thing that you saw with DXYZ, right? And you see a lot of these gains being given back. But if you guys remember for DXYZ last year, what was it last year? When they went IPO, or I don't even know if it's called IPO or whatever it's called for these companies. But when they started here back in 2024, they started at about $10 and they went all the way up to $100 because people were like, "Oh, I want to get a taste of some of these private companies, right? That they don't have access to in the public markets." Ran all the way up here, and you saw a pull all the way back to where it started. You're probably going to see the same thing with VCX. I am certainly not chasing this thing. All right, you're especially in this current market. I would be very careful trying to do it. Do I think memory is cyclical right now? To be honest, this is like. Let's take a look at Micron, for example. Back here, Micron was trading, I think it was around a 15 PE, right? Micron from $100 is almost 4 times that amount and trades significantly cheaper. One thing to remember with memory companies, they are very cyclical by nature. They're much more cyclical than semiconductors, which is cyclical in its own nature too. And if you bought Micron down here, you're cruising right now, right? You're cruising right now. I can't see which stock ticker you're talking about. Oh yeah, I'm talking about Micron right now. Actually, there is a way to put the symbol in the back so that way you guys can kind of see what I'm talking about. Background. Yeah, I forgot exactly where it is in here. Ticker. There we go. Wow, you can't even see it. Let me try one more thing over here. Oh, that's the reason why. And let me do that. There you go. All right, so I'm talking on Micron right now. I mean, the chart is kind of breaking down over here. This looked a little bit like it was going to come for a bounce here in the 50 EMA because every single time it's tested this 50 EMA back here in November, it bounced, right? And then it bounced off this 50 EMA over here on the daily. And then it bounced over here. And then it just broke right through it over here. So it's like you really got to believe in this story that it's going to come back. If the market continues to sell off, it's very likely Micron's going to sell off too. You do need to see that comeback and that risk on back in the market for this to come back. I think this cycle lasts a lot longer than people think it's going to last. Not for memory, but for semiconductors, especially since you're seeing anticipated spend actually increase for a lot of infrastructure, for a lot of mega caps. And even NVIDIA, Jensen Huang himself said during the event last week was that NVIDIA is looking at a $1 trillion revenue as a whole through 2027. I think that was like the exact figure that he gave. And that only includes Blackwell and Rubin, but it doesn't include it doesn't include Rubin. I think that only includes Blackwell and Hopper, maybe. Anyways, I don't know exactly what it was. The market got very excited about it, and then it sold off right after that. But I do think that this cycle is going to last a lot longer than people expect. I mean, let's look at this for like the last couple of years. We did see people always calling the top of NVIDIA all the time. And they were wrong quarter after quarter after quarter. But the kind of change in narrative that we've seen lately, not really narrative, more in the price action, was that people think it's going to last longer, but the stock continues to sell off, right? And more times than not, the market is going to be right in most of the scenarios. Now, is it going to come back? I don't know if it's going to come back. We definitely need to see whatever happens in Iran pan out, and we definitely need to see that war end for a lot of the fears to be taken out there. A lot of what you're seeing right now in the fear is a lot of the oil markets, right? But you also have the fact that people think, all the NVIDIA bears out there think that NVIDIA's time is over, and they say it every single quarter, and NVIDIA keeps on coming back as it runs their earnings and then pulls back out to the earnings. But now you have this overhang about a supply shock for oil. And a lot of the rise in revenue that you're seeing for NVIDIA, as well as memory stocks, is really of a result of pricing power, right? So less supply and higher demand means higher prices. Law of supply and demand, right? So everyone knows about the law of supply and demand, business 101. As you decrease supply and you increase demand, prices go up. And this has been happening lately for memory companies. So dramatically it's been happening. And your big three high bandwidth memory players, Micron, Samsung, as well as SK Hynix, have really been reaping a lot of the benefits of this upon the higher prices of memory. And that's the reason why you saw Micron guide for so high next quarter and guide for so high in the bottom line. And that's the reason why Micron's trading significantly cheaper today than they were when their stock price was 1/4 of its price. Right now, I would think the fear has always been in oil as it is right now. Oil is trading $95. When you think about the supply constraint from oil, you're getting a lot of distribution across the entire global economy, not because of the price of oil goes up, because the fact that oil is really used for everything. It's used in plastics. It's used, of course, to build semiconductors. It's used in all this machinery that TSM is using and that ASML is building. It's literally used in everything. So if the cost of oil goes up, that means the price of everything goes up dramatically as well. And we're not going to see these prices go up for these other items today from the higher oil prices, but the market is front running that because it's bidding the prices up. It's bidding the prices up for oil, but it's also bringing the prices down for a lot of these other companies. And generally speaking, when you see the price of oil up, which in 2022 we saw oil like $130, right? And then we had a bear market, of course, in 2022. If we keep seeing oil $90 and above, especially in the $100 range for the next few months, the market is probably going to be lower. And it sucks to hear that, but that's just the way the stock market works. When oil prices are at its peak, that's usually when the stock market bottoms, but we don't know where that peak is. In fact, I thought oil was going to come down pretty dramatically back here, and it did, right? And this is when the market kind of bounced, and then oil prices shot up again. And then we thought it was going to drop down here before, and then it shot up again. So like, you're really seeing the oil prices stay afloat for a long period of time. And that is really the scare that happens in the stock market, the fact that oil prices keep on staying higher. So we really need to see the war come to an end. Like, I think a lot of people really agree with me in that one. Isn't Pershing Square public? Or are they public? Yeah, they might be public. Pre-IPO over here. Oh, no, we don't have that. Yeah, Amazon is obviously down. Google's down. Yeah, I think Bill Ackman's down about 20% year to date, which really sucks. So I think we're like totally going to hear a long 5-paragraph tweet from Bill Ackman sometime soon, because like this guy does not stay quiet when he's losing a lot of money. When he's losing a lot of money, he starts tweeting. And when he starts tweeting, something happens. Yeah, he's already like retweeting stuff here. I think we just listened to this one. Hagswick just called out the media. These cameras have a choice. You either inform American people. Yeah, so Bill Ackman is definitely going to start voicing his opinion. Mostly it's just been retweets lately. But like, look, he's already like starting to talk about the war and stuff. It's only a matter of time till we see a no from Bill Ackman. Only a matter of time. I'm actually surprised he's reposting this one. It's pretty crazy. I just think the market doesn't believe Trump has this under control. That's really is the scare here, right? Because every time we think he has under control, he doesn't. And I'm not going to be political over here, and I'm going to tell you like, oh, I'm a left wing, I'm a right wing, whatever it is, because honestly, I don't think anyone really cares about my opinion on that one. And personally, I don't really have much of an opinion on that. I just want the stock market to go up. If you ask me, there really isn't a presidential regime where we don't go into a correction. Every presidential regime comes into some sort of recession or some sort of correction at some point. And it doesn't matter whether you're left or right. This is going to be a fact of the matter, and they're all going to blame each other. The question is, in this very moment, the market does not believe Trump when he says the war is going to be over soon. And this is why the market's down about 7% from its all-time high, because they're calling him out and not believing it. And that's mostly is being expressed through the price of oil. So it's really all the same trade. If you're sitting here, full port, ExxonMobil, and Chevron, you're swimming through this. You're glad because you're probably up like 30, 40% year to date. But like all of us, we're in growth stocks. So you're going to experience a drawdown. Nah, man, Amit sounds like Amit. I don't sound like Amit. I already gave my thoughts on Reddit earlier. Great company. Their margins are amazing. Same with AppLovin. But in this market, it just hates these stocks right now. So you got to be kind of careful. Trigger for recession is 108. I mean, there's like a 36% chance that we're going to get a recession this year. So, kind of hard to give those numbers, but yeah, you got a point there. If oil is at $108 for a long period of time, we're definitely going to get much lower in the S&P 500. Rand prices aren't going up. They're going to come down. If you need a laptop, buy now for it. Yeah, actually there are some charts where I'm saying Rand prices stagnate a little bit. There was one that I saw earlier today from Kobe SE letter. Let me look for that. Is this? Oh, this is actually pretty interesting. Now, I'd be careful with Kobe SE letter because they spread a lot of fear in the market. So I wouldn't read into everything and mean like, oh my goodness, look at this chart. The largest amount of institutional clients were the biggest net sellers last week. I'm going to sell everything. Or you look at this and you're just like, oh, they were the biggest net sellers last week. So that means that I have to buy now because they're going to be diving back. It's like, guys, we don't even know if that's going to happen. Because if you look at the AI sentiment survey, all right, this gets reported every single week. And you're at about 50% of people in the survey bearish. You could have looked back here in the beginning of March and been like, holy cow, this is a lot of people bearish in the median. That means we hit a bottom. And then things clearly got worse, right? If you look at the CNN Fear and Greed Index, we're at an 18. 1 month ago, we were at 42. And I do remember people saying to buy the dip at 42. In fact, oh, actually, I can't. Oh, here we go, the timeline. All right, so Fear and Greed Index was like at 25. And people were like, oh, it's extreme fear. That means it's time to buy. And like, look, we drooped down a little bit lower and the market's a lot lower, right? So this isn't your all end all be all indicator to buy the dip. This could be like one of the tools in the basket. One thing that I always look at, guys, and I've said this many times on Twitter, is that your exposure index, this is the survey that they send out to a lot of fund managers. And this basically says their positioning in the market. I say it all the time in my streams. This isn't the end all be all indicator either, but this goes from minus 100 to 200. When this is minus 100, it means that fund managers are mostly short the market, actually max short the market. When this is 0, it means fund managers are neutral to the market, meaning that they're not long, they're not short, right? They're just about neutral. When it's at 100, it means that they're max long the market. When it's at 200, it means that they're double leverage on the market. And I pointed this out, right? We had 66 print on here 2 weeks ago. 2 weeks ago, the S&P 500 was at 6,900. And you could have said this is the bottom because you have a massive deleveraging from 100 back in December all the way down to 66. So you had about 33% of degrossing of fund managers. but the S&P 500 was at 6,900. And now we're lower and we're still at 68, right? This is not your end all be all indicator. I usually attribute this to price action if I'm looking at a time to buy. We crossed the 200-day moving average last week. Since then, it has been massive chop. In fact, we went down, we came back, we tested the 200-day moving average, we back tested it, and now we're lower, right? Is this, oh, I'm sharing the wrong chart. I was looking at the moving averages here. Is this the time to be buying heavy in the stock market? I will wait to buy when we start to see some recovery. Until then, I'm going to just wait a little bit. Maybe I'll do some trading here and there, but I'll just be very, very careful on buying leaps and everything right now, because you can get murdered on those if you have it in size and you don't practice good risk management. Is Vistra Corp a good buy right now? I haven't really looked too much at Vistra Corp. I think Nancy Pelosi owns this one. Actually, let's see. I want to see the Nancy Pelosi tracker here. Has she been doing any buying lately? Let's see here. What are her trades recently? She hasn't done anything since January. So in January, she was buying some Amazon. Oh, no, this is because she just exercised some options. And then she sold some stuff too, I think. Yeah, but she bought Vistra Corp back here in January. I think she bought even more Vistra Corp. But what's in her portfolio right now? Oh, man, I don't want to sign up. Anyways, she's definitely not doing any buying this year. Last year, she did a lot more selling than buying. And what is, do they have the Jim Cramer inverse? They have a Jim Cramer inverse ETF. Is this for real? How's this doing year to date? Nah, it's not for real. But they do have this account over here, the inverse Jim Cramer. It was actually really funny because Jim Cramer did say the stock market was oversold last week, and then we ended up going lower. So, yeah, undefeated. I don't know. Some of these images are funny. But yeah, any thoughts on Adyen? I have no thoughts on Adyen. I don't know too much about this company, so you might need to check that one out. Did Trump tweet lately? Cramer went long SoFi this week. Did he go long SoFi this week? Oh my goodness. Let's see here. I'm trying to look on something on the side to see if it went long this week. No, I don't see anything that it went long this week. Maybe he said he went long on the on his investing club. I want to actually see if there's anything in CNBC right now. Yeah, there's not really much going on right now. I want to look at. He's not really going much right now. Oh, actually, Ed Yardeni was just on CNBC lately. I do really like listening to this guy. Ed Yardeni is historically a bull, and he's actually getting a little bit cautious, which is very interesting to see. Oh my goodness. I keep doing that. Holy cow. That was a 4-minute clip. All right, I'll play that one more time. So I saw someone say earlier, look at the chart. And I was like, what am I looking at? I know I'm blinking too much.
We don't know. But
I'll
let's
play
ask
this one more
somebody
time.
who does.
And then I'm going to stop it in the
Yardeni.
middle of it.
He's the president of Yardeni Research.
Can you hear? Let
He
me
is
know if
on
you
set.
can't hear it.
We're glad to have you, Ed.
Thank you very much.
So what? Let's say we don't get a hike or a cut. We get the same level of Fed funds rates all year. What happens to
None
equities?
and done is where we're at.
None and done.
None and
I
done.
like that.
Yeah, I think that's what we're going to see this year. Look, the economy has been remarkably resilient since the beginning of the decade. I think it's getting stress tested again once more. This time, of course, with this war in the Middle East, with oil prices going up. I think the economy is going to weather the storm. I don't think we're going to go into recession, though I think the risks of that are increasing, but I think the economy will make it through. I think the Fed is between Iran and a hard place.
Yeah.
You know, I don't think they can do anything. They don't know, you know, and by the way, Powell, when he gave his press conference, I guess it was a week ago, he mentioned the words, some combination of "we don't know" about 20 times.
How is it muted? How is it muted? That's crazy. Hold on. Let me try something here. Let me know if
And
this
if you
is
say
muted
you
right now.
know, if anybody out there says they know exactly what's going to happen,
They go to poly markets.
yeah, they should go to Poly Market, and maybe you should ask them where their time machine is, because they've come back from the future.
Yeah.
Because I don't know anybody else that knows exactly what's going to happen. And given that
Are you guys trolling me? Oh my goodness, guys. All right. Okay.
environment, Ed, how do we invest?
Well, I think you just stay put. I mean, I think I don't know if it's too late to panic, because people may panic over the weekend depending on how things unfold with Iran. But I would stay put. You know, I don't think you can game this very well.
Is there a point at which we don't stay put because it drags on? And historically, the stock market has not reacted well to energy shocks.
It has not acted well. As a matter of fact, we all remember the 1970s, the stagflationary period. There were 2 oil shocks back then. It was a dead period, a dead decade for the stock market. So that's not out of the realm of possibilities now that we've got an.
Okay, so Ed Yardeni is not all out bullish. That's what I'm taking away from this, because this guy has been bullish since 2023. In fact, he started getting bullish in the middle of 2022. And he's always been proponent about buying the dip. Lately, in the last few months, he has been more cautious. He's still a bull, but he's being cautious.
Oil shock, and we had an oil shock at the beginning of the decade, back in 2022 when Russia invaded Ukraine.
Yeah.
So we are going to get something that looks like a twin peak inflation situation. But I think the difference is going to be the resilience of the consumer, the economy, capital spending.
Oops.
I have to say, and I've been doing this long enough to kind of give my sideways opinion. I am a little shocked at how resilient most of the stock market has been.
Really.
Yeah. I mean, I know we're down a couple percent from the highs, but we rallied huge
absolutely.
into it. Are you surprised at how resilient we've been?
I'm not surprised with the resilience of the economy so far. It's still to be tested. And therefore, I'm not that surprised by the market, because the other thing that's happening here is apparently industry analysts haven't gotten the memo that there's a war going on and it might cause a recession, because earnings expectations have actually gone up. The analyst expectations for the
Are those wrong? Is that wrong to do that? Energy, while
Still
critical,
it's
is the lowest
Yeah.
percentage of the GDP input cost that it's been ever in American history.
It's not going to make a big difference. What is making a big difference is that we continue to see that earnings expectations are rising in technology. There's a lot of controversy about technology these days, but the analysts collectively keep raising their estimates for that sector.
but yet there has been a drawdown in the Mag 7, a pretty good drawdown.
Yeah, and it would have been more if it hadn't been for the analysts raising their earnings. In other words, the valuation multiple of the market, overall market, with the Magnificent Seven has gone down from about 22 to 20. It would have been more than that if earnings estimates hadn't been right.
Do you think that drawdown in the Mag 7 is related to the war? I don't see what the connection is, other than maybe
It's a
nat gas as an input cost to AI.
It's a whole different war in that. It was we talked about it before when I was here, and that's kind of the Game of Thrones. For a long time, there were 7 independent kingdoms surrounded by moats, happy with what they were doing, really weren't competing with each other. AI suddenly created an AI arms race, if you will, and now they're all competing with each other. They're spending a lot of money, so the game has changed. It's still the Game of Thrones, but it's more competitive. Let's put it that way.
All right, so I did want to bring up a chart over here with Ed Yardeni's research. I really like the stuff that he shares over here. Well, I closed that window because I freaked out the fact that you guys couldn't hear me. But let me open it up. Yardeni research, SP earnings, the economy. I believe this is it. Yeah. All right. So these are the forward earnings for the SP 500. Actually, hold on a second. All right, earnings growth. Okay. Well, this is probably it. Yeah, so he's basically saying the earnings yield is going up. Why doesn't he go to? All right, so I guess it's going up. All right, so he's saying that it's going up. You know what? There actually is a better chart here where it zooms in. I thought. Okay, well, that's just earnings per share. This is the earnings yield year over year. This really is the one that's going to make the market go up. And he's arguing that this year so far, the estimates are going higher. So if the estimates go higher, the market should be going up, right? And he's kind of pointing at this divergence where the market's going down, but the earnings yields are going up. Why is that so? So when you think about the earnings yield, this is the EPS growth that is obviously mostly weighted toward the mega caps are actually rising. I think during 2025, you saw the earnings estimates came down a bit. But there was like actually a point where the market was still going down, but the earnings yields were actually going up. But since then, it's been continuing to go up. Yeah, actually, you guys can definitely hear me. All right, so I guess the question is here that Ed Yardeni really has, which I mean, I don't think it's necessarily a question, but something that made him kind of peculiar was that, look, the earnings yields are going up, but the market's going down. He doesn't actually think that I think what he's trying to say is that there is an impact from the war that's happening, but he thinks that it's possible that we might have a 1970s event where the market was just basically flat the whole time. If I go all the way back here to the S&P 500, I'm going to share this screen. We'll take a look at what happened in the 1970s. I'm going to do the monthly. All right, so let's go all the way back to the 1970s, all the way back here. All right, so let's look at the 1970s over here. So go back to the 1970s. You saw the market peak here around 1972, and for nearly a decade, it just really didn't go anywhere. It bottomed around here in 1974, and there was obviously an inflation scare back then. If I do, does USO go back that far? No, I don't think it does. Hold on. Let me see if I can pull up something here real quick so I could share it. Stock market, 1970s, oil inflation. All right. I can't really find a chart on it, but yeah, there was definitely an oil scare around this time. Oil went all the way up to, yeah, you guys are trolling me. I know you're trolling me right now. You guys can definitely hear me. you had basically SP 500 flat. And what he was saying in this interview is that we could have that moment again. Now, he's obviously not saying that it's going to happen for sure, because he's saying that earnings yields are still growing, right? So the fact that earnings yields are still growing means that companies are still making more money in the bottom line, which means that the market generally goes up. You know, if you zoom out on certain charts, you can see that the market goes up as earnings yields continue to go up. And we kind of had that happen back last year, where the earnings yields go up, but the market was going down, and then it all recovered, and the earnings estimates actually went even higher. I think they were forecasted to be around 7% yield. They actually ended up being like low double digits, around 10%. What's happening here is weird, because we are seeing the earnings yields go up, but we see the markets continue going down. So do we have that same situation where the companies are actually doing just fine, and this is a buying opportunity, or maybe not? I think that's really what it is right now. I'm not on mute. Get out of here. How am I on mute? There's no way I'm on mute right now. I know. Guys, stop trolling me. Stop trolling me. All right. So anyways, we did just get some news recently regarding one of the Feds. Let me share this one. Well, we had I actually said this earlier, the European Central Bank pricing the 64% chance of a hike in the April meeting. That would not be good. Seeing the ECB hike rates would just not be good. Feds, Lisa Cook, we were getting close to 2% target. Tariffs took us away from that, and this war takes us even further away from the price target. Balance of risk is shifting more toward inflation. All right, obviously an inflation scare, okay? I think really the big question is, are we going to continue saying this? Is this actually going to happen? Is the ECB really going to hike rates next month? Or is inflation really become an issue again? And we saw that print from PC recently, and they weren't that great. The market is really just moving along with what they expect to happen. And right now, what they're expecting to happen is just not good in general. So I think it really is just a time to kind of wait and see. And it's weird, because you're having these mega caps just continuing to fall. Hold on, where is this one from Meta? Why is my chart looking weird right now? Here we go. Yeah, you're having these stocks continue to fall. Meta is like really the weirdest one, because the margins for this company is like really good, and they're literally selling this off. I was actually very surprised to see them sell off this massive gap up from the previous earnings. I still remember that day. The Meta gapped up like 10%. And this is not a small company. This is like a $2 billion company. And then since then, from that post-earnings gap up, it's down like 25%. So Meta is definitely in a bear market right now. If I go all the way back to its all-time high, it's already 30% down from its all-time high. And this thing continues. It's down 8% today, guys, 8%. You know, and the weird part is that not every single mega cap was down. Apple was green today. Of all days, Apple was green. But then if you look around, Google's in the 280s. It dipped into the 270s recently. NVIDIA is down 4%. Google's down 3%. Amazon's down 2%. Microsoft is down 2%, continue to make lower lows. This is really what's weighing down on the market. If these stocks continue to go down, the market will continue to go down. Hopefully we get a little bit of bounce, guys. It's up about 29 basis points after hours. We'll see what happens tomorrow. 60% of you guys think that it's going to be green tomorrow. I hope it's going to be green tomorrow, because I don't enjoy losing money every single day. And I'm sure a lot of you guys don't enjoy losing money every single day either. So we are just going to have to wait and see what's going to happen over here. Yeah, I wonder how the lines are at the airport. Flight got delayed. Crazy. Is there like a JFK airport? He's probably at Newark right now. Let's see if there's like a live view of the wait times. All right, here we go. We have the wait times for security. Wait times at JFK is 15 minutes this morning. These look like normal wait times. I think these are average wait times in general. Yeah, okay. So current wait times at I think Terminal 5 is JetBlue. That's a big terminal in JFK. 7 minutes? Is it really 7 minutes? I don't know. I feel like let's look at where Amit's at. I don't get it. It's a 10-minute wait. Why? Oh, current wait is 20 minutes. TSA pre-check. I guess should have done TSA pre-check. I'm guessing this dude is an EWR. Newark. And he's going to LA. That's like, yeah, I would think that's crazy. 40 minutes, 3 in the morning. I don't know, guys. This is nothing compared to LA. LA is pretty bad. LA is very bad when it comes to security check. Well, we'll see what happens. Hopefully it gets there before Saturday. Otherwise, it's not going to be a meetup. What are my hedges? I don't got any hedges right now. I play hedges on the day, short-term swings with hedges, because sometimes you're in a hedge and you get your face ripped off. But I'm not in any hedges right now. I guess cash is my hedge. I got like 10% cash, but that is certainly not enough to insulate me from the drawdown. Definitely not enough. Definitely not enough. All right, guys. That is about it. Thank you all for joining here. All 400 of you, certainly not 8,000 of you, but it's all good. I will see you guys this weekend. I do live in LA, so I don't need to take any flights or anything. Yeah, LA is horrible to fly out of. It is very bad to fly out of on a Friday. But we will see. For people who are looking forward to seeing the solid report next week, not going to be here. I'm going to be out of town for the next couple of weeks. So today's probably going to be the last stream I'm going to do until, what's the calendar looking like? Until April. I come back on the 10th or the 11th, I think. I think that's a Saturday. So the first stream we're going to see when I come back is probably the 13th, but I might be so jet lagged that I'm not going to do on that day. So probably Tuesday, the 14th is when I'm going to be back. Obviously, Amit's going to be back. He's going to be reporting to you live all the time. And the show always goes on regardless, guys. We got to keep the torch on. We got to keep the show going on as always. I mean, Steve, I think him and Chris actually just arrived. So they're hanging out. Obviously, they're not going to be streaming, but they'll be doing the market open. I don't know about the market close. Let's see if we're all going to be in the market close tomorrow. Let's see. All right, guys, take care. Thanks for joining in. Really appreciate